This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment for May 20th. Well, the day started out with the G7 finance ministers and central bank governors meeting in Japan. The formal meetings begin today and finish up tomorrow. Any statement will therefore be released on Saturday when the markets are closed and will affect markets at the opening on Monday. Now, I expect some kind of statement about how the G7 is against excessive volatility in the currency markets, whatever that is, even if it's only the Japanese delegates making the point in their press conference. As a result, dollar-yen could gap higher at the opening on Monday. Now, there's nothing major on the schedule during the European day until the North American day starts up today, whereupon the focus is going to be on Canada. So this morning, I'm going to discuss Japan's claim that they are considering intervening because of excessive volatility in the currency markets. My impression is that despite all their talk about volatility, they mainly try to keep dollar-yen within a broad range between 80 and 140. Volatility seems to play very little part in their decision, as far as I can tell. Now, this graph shows the course of dollar-yen and all the intervention that Japan has done on the record. Intervention to sell the yen, in other words, to weaken it, is in blue, while intervention to buy the yen, to strengthen it, is in yellow. As you can just barely see, they started intervening in 1991 to strengthen the yen when dollar-yen approached 140. They switched to selling yen to weaken it in 1993 when it broke through the teens and got to 112, and then close to 100 yen. Again, buying yen in 1997-98 when dollar-yen approached 130, then turning around to sell in 2003 when it got into the low teens. Then began their first bout of major intervention when they intervened for months and months, finally holding the line at 103. They subsequently stayed out of the market until the yen really started soaring again in 2010 and 2011. They intervened most heavily just below 80 yen to the dollar. Now, we can see the pattern better if we look at how much intervention they've done at each level. As you can see, there's a spike for their yen selling operations around 106 and 116, 117, and then enormous selling of yen below 80. Now, let's look at how this compares to volatility. For a measure of volatility, I'm using the monthly range, the high minus the low, as a percentage of the low. As you can see, there's very little connection between the volatility of the market and intervention. In particular, the heavy intervention in 2003 and 2011 wasn't caused by any great surge in volatility. Of course, the intervention itself would tend to dampen volatility, and so it may be hard to detect volatility periods using monthly data. But even with a more granular view, it's hard to discern any pattern. The following graph uses the standard deviation of the day-to-day changes in dollar-yen over the previous 5 days as its measure of volatility, and plots that against the amount of intervention. There isn't much connection. In short, the Japanese seem to be more motivated by the level of the currency rather than the volatility. Looking at past data, I'd expect that if dollar-yen went below 100, they might start intervening. Under the current circumstances, however, I expect the Fed to save them the trouble by widening the expected interest rate gap between the dollar and the yen, thereby pushing dollar-yen higher. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.